things that we do to help you close your transactions. I mean, I can't go over everything at once, but I can give you little tidbits of some of the things that we do. So how many are you familiar with SBA loans?
Yeah.
Okay, most of you. Okay. And what is a typical down payment on an SBA loan with real estate? Does anybody know?
10 to 20.
You could do, yeah, as
You could
little
put
as
10 for
10%
experience
down.
in my business.
Yes.
10% down is fine.
Right.
Experience.
So
They have to occupy 50%.
you have to occupy 51% of the property, correct? So what do they look for? If you're gonna go with minimal down, 10%, they're gonna look for cross-collateralization. What does that mean? If the people own a residence or another commercial property or even another residential property, they're gonna go ahead and they're gonna put a second lien on that property. So what happens is, as the property develops more equity as time goes on,
Guys have enough equity.
and the people want to free up that property, let's say to sell the other property that's encumbered, the SBA will allow them to get a release on that property, provided they're not going to just take the money and run. They have to go ahead and take the money and pay down their SBA loan, or if they're refinancing another property to get a better rate, the SBA will go ahead and resubordinate and allow them to do that, providing they're not pulling cash out. So they're lenient with that. Now, as far as what kind of borrowers are we dealing with, we're dealing with a business owner. Typically, they want to see 3 years experience in that line of work. Now, I've seen some where we've done it with less than that, and sometimes, let's say 2 years is adequate, and they're gonna look at the financials. That's very important, especially the current financials. I'm doing one loan right now for a gentleman. He owns a metal fabrication shop, and he is trying to refinance through the SBA, and basically when we looked at his deal last year, he wasn't showing any profit. So we sat down with him, we told him what numbers we wanted to see, and he basically, the next year, which he filed for 2018, he provided higher financials. It was good enough to where we could now go ahead and do the financing. He'd been in the business for quite a long time, but wasn't showing much profit. So instead of writing off everything like typical self-employed clients, business owners, we have them write off a little bit less, so we made it work that way. Typically on an SBA loan, you're gonna get if it's with real estate, it's gonna be 25-year amortization, and you could do say 5-year fixed increments in the loans. So 5 years, the loan could get recast, another 5 years, and so on and so forth till the full 25
Doesn't
year.
go all the way for 25 years, like fixed?
No, they typically, they're not gonna do that. Or you can go with the ARM product, but most of the people go with the 5-year recast. Now, if we're looking at traditional bank commercial lending, does anybody have an idea what kind of LTV we would require on something like that?
Loan to value?
Yes.
About 80%, I mean, lending 80%, probably more right now, I would say. What, 40, 35, 40?
You could do as little as a 25% equity, meaning we'll give them a 75% loan to value. But remember, on the commercial, typical commercial transactions, it's driven by cash flow.
Sure.
So if even if it's an owner-occupied property, the lenders are going to typically look at what kind of cash flow would that property derive. So if it's a single user property and it's only got one source of income, they're gonna look at what the market rents are for that property, and they'll analyze it, and they'll say, okay, if the market rents will sustain that loan amount, they'll make the loan. If it's not, they may look to the borrower and see if his global cash flow is strong, and then they'll still make the loan. But if his global cash flow is not good, then the loan may be declined because if something happens with that guy's business, he's not going to be able, obviously, to make the payments. Does anybody have any questions, comments, anything so far?
Little
Yes.
question, on a 504,
Yes.
you can do up to, I think, a 30-year amortizing, right?
No, typically they go 25 years. Yeah, you don't usually see a 30-year amortization on those.
SBA was usually 25 years, yeah.
Yeah, and if you have just a business only loan, typically those are going to be a maximum of 10 years.
Okay.
Because the business assets, they're going to depreciate, so nobody wants to lend for longer than 10 years. And the other key, if it's business only, they're going to look at the lease. It's very important, because if you're doing a sale and the lease comes up in, say, 3 more years for renewal, if they don't have an extension on that, they're not going to get a 10-year loan, because the lender's going to say, well, what happens? The lease is going to expire in 3 years. We'll give him a 10-year loan, and he's going to be out of business. So they're going to ask the landlord to see if they can get an option. So that's very important when you're showing these businesses, that you look at the lease very carefully, or find out if the lease can be extended for at least, let's say, 10 years. Now, if it can't, let's say it's 5 years, you're only going to get a 5-year loan. But the problem is, it's going to be amortized over 5 years. So it's not going to be 25 due in 5. It'll be a 5-year fully amortized. So the payments are going to be quite high. So you always want, look at that lease very carefully, and talk to, if you're not the listing agent, you're the selling agent, find out from the listing agent, what's the situation, and can we get an extension on that lease? And that's gonna really help, down the line when you're getting the file approved. Okay, any other questions so far?
Let me ask you a question. Somebody's buying a business.
Yes.
They're paying $1 million. Let's say the business nets $200,000. Would they be able to finance $80,000? Given the lease is right?
800,000?
Yeah.
With how much? 200,000 net?
Net. Let's say $1 million price, 200 net, 800,000.
Yeah, that would.
Would it work?
That would cash flow, yes.
Yeah.
So you could do it, and then you'd have to look at what's the lease term again.
Sure. Give me the
But
lease is that.
if it's a nice lease, let's say a 10-year lease, it's got that kind of cash flow.
Right.
Now if the buyers have other real estate, they're gonna look at collateralizing those assets. But if not, he could come in with 20 to 30% down, and that's definitely something that they would look at. Now, also, what's very important is if the seller is showing good financials, because how many of you sell restaurants? Anybody have any experience in that? Okay, well, we've done a lot of restaurant loans, and restaurant owners, typically, they don't show, a lot of income. They write off everything, and it makes it a little bit difficult. So here's the catch. If you have a buyer with good restaurant experience, and he's gonna buy, let's say, a restaurant only, or the restaurant with real estate, that's a loan that can happen, provided his experience is good and his taxes are good, that he could show he's a strong operator, he's got experience, he's showing, good income over a period of time. That's if the seller does not, show good income on his taxes. Now, If the buyer is not as experienced, but the seller has good tax returns and showing good cash flow, then they'll look at that loan, but they'll probably ask for cross collateral from the buyer. If the buyer owns a home or he has other rental property, they're gonna tie up those assets too. So,
But that's gotta have enough equity though.
yes, correct. I mean, yeah, and typically
Collateral.
when they cross collateralize, they want to see at least 25% equity left in the property once they put the second lien on that property. So,
Is that all? 25?
well, left over, yes, yes. So they want to see at least that much equity left over. Now, the other thing to keep in mind, if you have a seller that's not showing income and a buyer that's not very experienced, you're going to have a tough time getting that deal through. And the thing that I want to coach you guys is, you know, when you start showing properties and things like that, you want to find out as much as you can about your buyer, because it's just like with houses. You have a client and you start showing in homes, and then they're not qualified. You've spent, let's say, several weekends showing them all these properties, spending your time, your gas, and then you find out that, oh, I like this house, I want to make an offer, and you find out you put them together with your lender, and the lender says, this guy doesn't have income, his credit's not that good. It's going to be the same thing with commercial. So the sooner you can put him together with a lender, the better, because you're not here to waste time. You're here to close deals, make money. I mean, I can help you do that, but you got to have a buyer that, he's qualified. What does that mean? He's got to have, reasonably good credit. FICO score, usually at least 650. If he's got lower than 650, guess what? We're going to be looking at private money, okay? Now that's with the real estate. If it's just business only, then it's probably not going to happen. Yes.
What if their finances are good, they've never decayed, anything like that, but they have a lower FICO because they don't utilize a lot of credit? And how does that play into the equation?
Okay. What I typically do, we do a lot of credit repair and rescoring of credit. So we're going to look at what's there. Maybe the reason the score is low, I mean, if it's not because of late payments, then...
They just, for my example, I don't utilize a lot of credit.
Okay. So in your case, we would probably ask that you get like 3 additional credit cards. And if somebody...
Really?
Yeah, and if somebody can't get a normal credit card, we send them to either Chase Bank or Capital One Bank and get a secured credit card. You can open up an account with, say, $500, and then they'll give you the credit card, and you can charge up to that limit. They'll give anybody a secured card pretty much, because the money is secured by money in the bank, so you can't exceed that, and that's building your score up. Okay, and so typically we do a lot of that. There's a lot of people out there who have limited credit or no credit, and right away we send them out to get the 3 secured scores. And also, if somebody has poor credit, what that does, it offsets the bad credit. Let's say they only have 1 or 2 good accounts and they have several bad accounts. By getting them 3 new accounts, and if they pay on time on those, it's going to negate the effect of the bad accounts. So that is a terrific way to, quickly get people's score. I mean, it's going to take a little bit of time, but it's not going to take years. Within maybe 3 months, you could really boost the scores up. And they don't need to max out those credit cards.
Just carry a balance.
Just carry a $50 balance is enough. A $10 balance. That's all. Don't overutilize the card. And that's another thing. If somebody's got a low score, but they're not late on their payments, chances are They're overutilizing their credit because the break comes in. If you go a 50% or higher in utilization of the maximum balance of your card, your score is going to drop. So if you keep it, the first break is at 50%. So if you have a credit card with $1,000 limit and you keep that balance under 500, your score is going to go up. The next break is at 30%. So if you have a $1,000 high balance limit and you pay it down to under 300, the score is going to go up more. And then the top score you will attain is at 10%. So $1,000 card, $100, pay it down under $100, that's going to be the maximum. You're going to get the most bang for your buck. Now, it doesn't always help to pay it down to zero. It's better to keep a little balance on it. If you have a little balance, that's actually better than paying it down to zero balance. So these are, nobody ever told you about that.
But
It
You know,
makes sense, because
but
the credit score is a reflection of how
May I tell you something?
much of a sucker
Yeah.
you are to borrow money.
Jordan, I didn't have credit as you. I used to use my debit card. And then I had credit cards, I was afraid to touch them. So what I'm doing right now, I have an application. I go spend $20, $20 appears on my credit card, I click the button, I pay it. I spend $20 or $50, it appears on my balance, I pay it. You buy, you spend, you buy, you spend, you know what I mean? You
Yeah.
pay for your bank account, you're gonna build your credit.
yeah. So yeah, just
Because I put everything on the credit card for the cash back. I pay it
Right.
off every month. I
Yeah.
didn't realize that.
yeah. And you don't have to leave balances on. I mean, you could pay your card, but always be buying at least something. So you have, let's say, $10, or you want to use some
But
utilization.
yeah, like I said, everything I can, I put it on for the cash
Right,
back.
right. And typically, you want to have 5 accounts. That's the best. If you have 5 accounts, that's optimal. You don't want to have too many accounts, but you don't want to have too few. Now, we can get loans for people with as little as maybe 2 or 3 accounts. But if you go less than that, 1 gets a little dicey. So, because that's a big precursor to a lender saying, is this person a good risk? They want to see how you pay your bills. And if somebody, let's say there's some people that deal in cash and they don't want to have, any loans, on their credit, is the bank going to go ahead, they're trying to buy $1 million property, are they a good risk? It's hard to find out if they are or not because there's no history. So history is important. Even if you're just shopping for a car, if you're buying a car and you have no car payment history, you are not going to get a rate as good as somebody that has a car payment history. You could have mortgages, you could have credit cards, everything else, but if you don't have car loans in your credit, your rate's going to be a little bit higher, believe it or not. So there's all these little nuances that they're out there. They don't tell you, but I'm trying
So
to.
what about for the first time you met, like someone is buying a car? Because like my son is 23 and I told him in order to build your credit this time, his lease is coming up in June. And I told him this time, I want you to go and buy it under your name and your credit. So now, as you're saying, it's gonna get it with a higher price.
Well,
So,
if he has good credit score and he has established credit, let's say if somebody had no credit whatsoever and they go ahead and open up the 3 secured credit cards and they utilize a little bit on those for say 3 months, their score is going to be good. I mean, it's not going to be perfect because the accounts are going to be rated as newer accounts, but it'll be better than not having credit at all. And then he'll get a good car loan, he won't get the best, but then the next time around, if he wants to again purchase another car later, which he may do, then he's going to get the best rate because he'll have some history. But at least you get him started.
You have to build a history.
You have to build, yeah. I tell people you can't start from nothing to 800 score just like that. It takes, you know, a little bit of effort. But if you know how the system works, you can get the scores up. And it doesn't take that long. And the other thing is, if you're working on a transaction and the scores, let's say, a little bit low, and you say, hey, Steve, my client wants to buy this property, but his score's like 640. Well, let me see his report. So I look at his report, and we see the utilization is kind of high. So rather than wait, because you're in escrow, you need something done quickly, what I do is I have him, you know, pay down those balances. Maybe it's below 50 or below 30, whatever what we need. And then once he gives me something from the creditor showing what the new balance is, I can go to the bureaus and rescore it. It only takes like 5 days to do that. So if it has to be something quickly, that's the way to do it. Now that there's a cost to that. It costs $50 per item per bureau. But if you're in a hurry and you're buying $1 million property, that's a small price to pay to get your deal through. Because otherwise, it could take 30 to 60 days for it to reflect, you know, on the report and the new scores to show up. This is a way to kind of hurry it up, get it done fast, get the scores up, let's say from 620, maybe it'll be up to 680, and then your deals, you know, you'll make your deal there. So
How we can do that ourselves? I'm sorry.
How long does it take?
I can do that in about 5 days. Yeah, so you get he pays the bills, just give me a something like an online statement showing what the new balance is. I take it to the bureaus. It's called a rapid rescore, and it takes about 5 days, and then we'll rerun the credit and the score will be higher. So I mean, we do it all the time on so many deals, and sometimes we just do it to get the borrower a better deal, because a lot of lenders, sometimes they're a little lazy. They just want to approve the loan, get on to the next one. Well, a lot of times I'll take somebody and, my God, you've got a 680 credit score, which is good, but if we could get him up to, say, 720, all of a sudden his rate's going to drop quite a bit. So I say, look, you've got this one credit card, your balance is really high. Why don't you pay it down? Pay it down to this level, and let me rescore it for you. And all of a sudden, we might save that guy $4,000, $5,000 in costs in the loan. He's a happy camper, because all of a sudden you saved him money and he didn't have any clue. He knew he'd get approved, but all of a sudden he got a better deal. And you didn't have to do it, but you went out of your way to make that happen. You've got a customer for life. I mean, that's what it's all about, because we're all doing pretty much the same thing, and it's how we attend to our people. What can we do to go the extra mile? That's going to make it happen. So if it's getting them a better rate because you're rescoring, credit, or just like getting a pre-qual letter, let's say, it's late at night, and you need something because you want to submit an offer the next morning. Well, if you're working with some of the big banks, you think you're going to get a hold of anybody late at night, let's say on a weekend or something, it's not going to happen. But if you call me and say, hey, Steve, I've got this client, here's a scenario, I need a pre-qualification letter. Okay, send me the info, I'll get it out to you, and you can get that, that letter written, because that's important whether, you're doing residential or commercial. The listing agent, they want to know that your buyer has the capacity to buy. So they want to see proof of funds. They probably, want to see his credit score, and they want to see that pre-qual letter.
Is
Yes.
there any website or anywhere that anyone just can go and fix their credits before they start putting offer down, or before they?
Well, you can go to freecreditreport.com, or you can go to Credit Karma, creditrepair.com. Make sure you go to the actual sites, because if you Google search them, there's similar ones. So go to the actual sites. They can, pull the credit. Now the scores that they will get are not always the exact score as you would see in getting a mortgage. They'll be close, but they're not usually exact. But it's okay, at least you can kind of get an idea what his score would be, and then you could see what the credit utilization is and the balance is, and if there needs to be something. And they could do it on their own if they want, but it's going to take time. And if they want to do it quickly, they're going to put an offer in right away, then you need to do the rapid rescore, and that you have to utilize the lender.
Someone they had a past late payment or something.
Okay.
Are they able to fix it here in the sites, or-
You know what? We utilize a really good credit repair company. So if they have late payments, I know.
I don't know that.
Yeah, I've used like the same company for a long time, and I've had pretty good success with that. Now, how do they get it done? Because the creditor has to follow certain rules when they put negative information on their credit report, and sometimes if they don't follow all the right steps, then it can get taken off. Now, just if you want to dispute it, and the lender or the creditor has so many days to respond to the dispute, if they don't respond, then they're obligated to take it off. And sometimes it'll just happen if they're busy and they don't respond, it can happen. But a lot of times the credit repair, if you're with a good company that really knows what they're doing and they really get into it and they find out how that they put that on there and they did it, let's say, illegally, then they may be forced to remove it. They'll threaten them and sometimes they'll take it off. Now, another thing with collection accounts, if you have collection accounts and they're open collections and the people are going to pay them off, the one key thing is you do not want to just pay them off and where they show it as a paid collection, because your credit will actually get worse, not better. Because what happens is it's a new entry as far as that collection account is concerned, and it's newer, so it's like something bad almost is happening on it, and the score will drop. So if you're going to pay off a collection account, you have to call the company and say, look, I'll pay this off, but I want it cleared 100% from my report. And if they say yes, fine. And even I tell people, don't pay by credit card, pay by check. On the back where you endorse a check, say payment of this debt constitutes payment in full and complete removal from my credit profile. Something to that effect on the back of the check. So if they cash it, they're going to be obligated to remove it from your report. And you have it in writing because the check's canceled. So you can go back to them and say, hey, you guys agreed you'll remove it from your profile. That's the only way the score is going to go up. So you have a few collection accounts. It could be small. Now the lender might not care so much that the collection is there, but it's hurting the score. So that's what a lot of times that matters. So you get those little collection accounts removed, and all of a sudden your score's up 50, 100 points. So a lot of things like that. And then counsel your clients, if they're going shopping like for the cars and things like that, only let one company run the credit, because sometimes the dealers, they all want to run their credit and they have 4 or 5 inquiries on their credit.
So how you can do
Yeah.
it? Like they don't even talk to you before
Why
they
is-
run your
yeah.
credit.
Well, you always sign something that says they can, whether you
Yeah.
realize it or
Yes,
not.
why
Yeah,
is the
exactly. That's what
credit
happened. One
goes
of my
down
friends.
for inquiry?
They
What
run
inquiry
their
has to do with
like
credit?
5, 6
Well,
times in one
because
way, and I
it
talk
looks
so much.
like almost like you're desperate for financing, that you're, like with credit cards, inquiries. Now, mortgage inquiries are not so bad, and
In 30 days, right?
well,
Within 20 days.
within a little smaller time frame, especially if you do it within a couple of weeks, you're going to be okay. But if you're shopping for credit cards or even cars, it doesn't look good because it looks like, oh, you can't get financing. You went to 4 or 5 places and they're all running your credit. It looks bad. That's why your score is going down. So just, you say, look, you let one company run it, whoever you're gonna buy from, and that's it. Or you have a copy of your credit with you and you let them look at it, but don't
The copy of the
authorize
credit
it.
is good for how long? Like for the date that, like today, for example, if I go to jail and they run my credit and tomorrow or next week I just want to go to Lincoln or to Lexington.
Yeah.
It's good for how long, this thing?
Well, it depends on the company, but generally they're gonna, at least for 30 days, they're gonna accept it.
30 days is okay. I
Yeah.
mean, you can make a decision in
Right.
30 days.
And
what
if you
wanna buy,
go
so.
to, let's say,
No.
freecreditreport.com or creditkarma.com, it's not a hit on your credit because you're pulling it. So there's no hit to the score whatsoever. So you could pull that, and if you want to ask for scores, you can ask for scores. Now they won't be always exact, but they'll be close enough, and you could show that to whoever is going to extend your credit and say, hey, look what I have here. Yes.
Every bank has an application. You go there on your smartphone, you click on it, and it gives you a score.
Oh, yeah.
Just-
Yeah.
They're all started.
Right, yeah, and Discover cards and,
Discover,
yeah, most of the credit cards are doing that, so that's another way you can
Yeah, I noticed
get
that.
your score. So there's a lot of different ways. So the credit, is important. The other thing that's important is the income. So again, when you're gonna show clients properties, talk to them, find out what their tax situation is. Sometimes people haven't filed taxes in 2 years. I mean, you're showing a property, and and don't be afraid to quiz them. Or if they're afraid to tell you because they don't want you knowing their personal financial business, have them talk to a lender and find out. Because believe me, they'll be looking at properties. They're not qualified, or they got to file their return. They filed an extension, but guess what? The extension expired already. So they've got to get that return filed, okay? Or if they filed, sometimes people file an amended return. You got to know if it's an amended return, if it's not at least 6 months old, the lender's not going to go by it. They're going to go by the original return because they think that you filed an amended return just to get this loan, so they're not going to accept it. So you got to make sure that that amended return is at least 6 months old. So there's just so many little details that you need to be aware of. And again, you can't know everything, so that's why it's important you talk to your lender and say, here's my scenario, this is what my client wants to do, what do you think? And just at least to get an opinion, and they can say, yeah, I think there's a good shot at doing that, let's get a file together. Or they'll say, hey, you're wasting your time. And it doesn't hurt to just say, I don't think you're quite ready. Maybe you have to tell them you're gonna have to save some more money first. We're gonna have to work on getting your credit score up. You're gonna have to file this return. Maybe you have a tax lien or something else that's gotta be dealt with. So it could be a lot of different situations. So that's the first thing. Get them cleared so that when you start showing them something, if they want to write the offer, then you're going to be okay because they're ready. But you just take somebody new and they always want to look at property and, oh yeah, show me this, show me that. Okay, sometimes I understand you want to show them a couple of places, but after that, hey, have you spoken to a lender? No. Well, can you tell me a little bit about your situation? And they're really vague because, they don't want you to know, or maybe they're ashamed of something that's happened to them. You know, and so you really need to dig in, because, and don't be afraid, because it's better to let that client go and get somebody who is going to be more qualified. Then you wonder, gosh, I'm working so hard, I'm working 7 days a week, I'm showing properties, and I'm not making any money. Okay, well, you got to look at why is the situation. Who are you working with? And what lenders are you working with? Are your lenders getting your loans through? I mean, that's the key. I mean, some lenders are, you know, they're ultra conservative and they just want like the gravy, you know, deals. Or there's a lot of banks, especially when you do commercial, they only want the bigger deals. You'll find that it's very common. Well, we'll only do $1 million loans and up, okay? They don't want to touch anything under that. So what do? You have to have a lender that's resourceful with smaller deals, because not every deal is going to be $1 million deal. I mean, they're nice when they happen, but also they can be more complicated. They can take more time, and you may get more turndowns with those. So sometimes you could do 2 or 3 smaller deals, they all close, and they add up to more than that one big deal that you've spent 6 months working on, and you're still trying to get
I have
it
a
done.
question. How big loans are you, or how small loans are you doing?
I've done deals as small as
What
$50,000.
is your range?
I mean, the largest loan I've ever done is maybe like 2.5 million. I mean, we can go higher than that, but generally people want to use this for the smaller
Let me ask you a
deals.
question. Let's say somebody is buying residential property, $500,000.
Yeah.
You obviously charge at least 1%, 1 point, right? On the loan, or not?
Well, how we work with Peak Finance on a residential, we are accredited, you know, by the investor. So typically, most of our loans go out at 0 points.
It's 0 points, so it's based on interest rate.
Right, it's based on the
On the
interest rate.
commercial, you charge.
Now on commercial, we do some that can be yield spread depending on the transaction. So we can offer 0 point loan to the client. Typically on commercial, they're at 1 point, but they can be done at less if people are very sensitive.
One more question. Do you refer people for referrals? Let's say somebody sends you a bunch of referrals.
What I do is I give out a lot of referrals to the agents that are sending me business, because I have lots of people that come to me. I've been doing this for 37 years now, so they're always asking my help. I just gave a referral to the Peak Corporate. It was on a home. They wanted to buy a home in Mexico. So you're probably familiar with Kim Schulte. She handles a relocation. Anyway, so I gave that to her, so she'll find an agent in the Century 21 system that'll handle that, and so that client will be taken care of, because he's looking for something in Mexico. There was a specific area he wanted, and you really need obviously an agent familiar with that area. So like right now, I have several people that want to buy, so I am looking for Peak agents to give those clients to, so they can show them property. And these are well qualified people. One of them is a doctor, very strong income. He wants to put $1 million down. So he's looking for commercial properties. So been a
What
client of
type?
mine for 20 years.
What type of properties?
He'd prefer like either office or maybe retail, possibly even like an assisted living facility, something like that. So yeah, but he definitely, I'll get somebody who's definitely qualified. If I give out a referral, it's not going to be a waste of somebody's time. These are people I've already vetted out, and we know, they're ready to buy. and I don't sell real estate, I only finance it, so I work with agents, so I typically look for the agents that are sending me business, and if somebody's sending me, quite a bit of business, they're gonna get, obviously, they're getting deals back, whether it's for homes, for commercial, whatever it is. Some people wanna do businesses, I get, business clients all the time that are looking for businesses, and the agents that would like to work with only do residential. So if there's somebody that can do businesses or can do commercial, guess where, they're gonna get referred to.
In residential, we cannot reward them on commercial, we can.
Yeah, residential, it's
Yeah.
it's a no referral fee policy, but at least, you get the leads, and secondly, you get the deals closed. I mean, that's the main thing, because if you're working with somebody and your deal doesn't close, they could promise you the world.
I have some ways that I could generate leads on commercial refinancing. A lot.
Yeah.
I know that. But I just want to work with someone to get compensated rather than wait somebody will give me business, because you follow me?
Yeah.
I have some way people would need my services, but I'm not specializing in it. So I want to work with someone, I would refer it, but I want to get compensation after deal closes. So everybody benefits.
Right.
I'm motivated and you're motivated.
Right. But if I'm giving you 3 good leads, solid leads of people that want to buy property, and you're going to be their only agent, that's going to compensate you far better than just getting a referral fee. So, but does anybody have any other questions so far? Okay. Let's see if we have a little bit of time left. So. So what I wanted to talk about is debt service coverage. If you look at the commercial sheet, it says commercial lending. This is the way most lenders will analyze a commercial property, either, let's say, a multi-tenant, office building, a retail center, or even an apartment building. Have any of you guys dealt with 5+ units? Have you sold any of those types of properties? Okay.
No, I know you.
Yeah.
Okay,
so
120 or 110? 125?
Sometimes we go down to 1-to-1.
Wow.
Yeah. So if you now what we're talking about is the debt service coverage. So if you have a dollar worth of income and a dollar worth of debt, that's considered a 1-to-1. Okay, so typically most lenders, they want to see $1.25 of income, and that's going to be against $1 of debt. So there's 25 cents extra for each dollar, of debt. And that's including the mortgage payment and all of the expenses like the property taxes, the maintenance, all of that information. So typically, here's a quick way to analyze something. If you have a property, let's say it generates $100,000 of income a year, okay? The fast way to analyze it is a typical lender is going to take about 40% of that, and that'll be the expense factor, okay? So $100,000 income, 40% expenses, that's going to leave you with $60,000. Okay. And are people familiar with cap rates?
Yes.
Okay, you all know about cap rates. So what do you see as a typical cap rate right now?
4.5.
Yeah.
4.5%.
Okay, not much higher than that.
Now in California.
Okay, okay. Does anybody do any out-of-state deals? Not right now, okay. All right, yeah, right now, you know, the cap rates are typically, you know, they're very low, 4.5, 5. So what happens is your buyers are typically coming in with more down, because at a 4.5, 5 cap rate, you know, back in the day, you could put 20% down and you'd be fine. Okay, now with such low cap rates, what are we seeing? What are we seeing now for down payments?
I would say 40%. If I were a lender, I wouldn't lend less than
Yeah.
40% of it.
So
5 or less.
you're not that far off. So yeah, so typically you could be at 35 to 40%, you know, down payment to make the cap rates work. Now, if it's a good, a better deal, maybe the cash flow could be increased. Maybe you can get, you know, a 30% down, but it's probably not going to be a lot less than that because of the situation we're in. And then different property types will command, you know, different cap rates. Apartments, right now, they have some of the lowest cap rates. If you get into retail, the cap rates will be, you know, a little bit higher. Medical will be similar to maybe retail. So, you know, but that's what's driving the market right now. So if you can get something with a little better cap rate, but also the stability of the tenants. If you've got weaker tenants and they look at the rent rolls and there's a lot of turnover with the tenants, that's obviously, it's not a good sign. If you have the stability with the tenants and or better tenants, and especially with retail, if you have a credit anchor and some decent tenants beyond that, then you can deal with, you know, a little lower cap rate. And then location. If you're dealing, like I'm in Upland, so I get a lot of transactions out in the desert, out really far in the Inland Empire. We do a lot of loans in Menifee, places you probably don't even hear about. And what happens is the cap rates need to be a little bit higher because of those locations. They're a little more remote, so lenders are more worried about, you know, tenants leaving, vacancies lasting longer, so cap rate might have to be higher. And how do we offset that? A better down payment. So sometimes it could be 40% down, or if it was in LA, maybe we'll do it with 30% down. So those are all you know, important things to contend with. So, but anyway, I just wanted to give you a brief overview, just some of the highlights of some of the different things. Now, with the private money, that's strictly equity. So we don't care so much about the cash flow. So if you've got a vacant building, you've got a building that's got some damage to it, you know, anything like that, we'll look at that maybe as private money, as a blanket loan. And so give them time to maybe fix it up, re-tenant the property. Our loans come with no prepayment penalty. So afterwards, you can refinance them into a better loan. But at least a lot of times the seller, they want to close quickly. You've got a property that's half vacant. Guess what? The typical bank, they don't want to touch that property. Okay, so take private money, get them into that property. Yes, the down payment might be a little bit higher, the rate might be a touch higher, but it gets them in the deal. Get them in there, get them situated, let them clean it up a little bit, get it tenant occupied, and then we'll take it, we'll redo it into a more conventional bank loan. But at least you get it closed, you get it done, and you get paid. That's the key. That's what, I mean, it's all about, you know, we're all on commission here. So if we don't help make your deals close, guess what? Nobody gets paid. And that's what it's really all about in the end. So I know if you come to me, I'm gonna do everything in my power to get that transaction through for you. Because again, I'm not here just to push paper. If I can't help you find a way to close that deal, if I've got to fix credit, whatever I've got to do, we got to make it happen. Because in the end, if you get paid, I'm going to get paid. So, and that's the main thing. So, any further questions about anything we've discussed? Yes.
You mentioned having about 5 credits.
That's ideal.
I know,
5
but
pieces of
does it
credit.
make a difference if they're all from the same bank as opposed to different institutions?
No, you could have them all from
So
the
let's
same
say
bank.
5 credit cards from Chase is
Yeah.
as good as, let's say, the other bank.
As long as they're separate account numbers, yeah, that's fine. Yes. And again, just a little utilization. Don't have to go hog wild, but just if somebody puts like $50 on something, buys a tank of gas, or shops for some groceries, it doesn't mean get 5 accounts and run them up to 50% or more. Keep the balances low. Keep a balance, just charge so you could pay it off at the end of the month, but do some utilization during the month so there's activity. Okay, and even if it's $10 could be the most ideal situation and it'll give you the best score possible. But if they just have 5 accounts and they're dormant, doesn't do you any good. So anyway, but again, I want to thank you for all of your time. You have my flyers, you have my cards, and then if any of you are interested, I have a really good mobile app that I can go ahead, if you give me your business card, I can send it to you. It's free, and then you could figure out payments, you could figure out debt ratios, you could do a lot of things, check rates right through the app. You don't even have to talk to a lender. So if you want that, again, it's free for you to use. Feel free, just give me your business card and I'll be happy to set you up. You'll get a text from me, and you just go ahead, open it up, download it, and then the app will be right on the phone with all my contact information. So,
I'll text you what you need email,
uh,
because we don't have business card. we just
Good
start
deal.
this.
Oh, okay.
I'll have your card, we'll text you.
yeah.